Economic collapses rarely erupt suddenly. Instead, they emerge through years of structural fragility, political mismanagement, and economic imbalance. The early signs are often subtle: rising debt, speculative investments, and weakened production capacity. These vulnerabilities accumulate quietly, even when prosperity appears strong on the surface. When a triggering event occurs, whether a market shock, geopolitical tension, or policy failure, these hidden weaknesses converge. The system becomes unable to absorb pressure, transforming instability into full-scale collapse. Civilizations that ignore early warning signs often face harsh consequences as their economic foundations erode and institutions lose the ability to respond effectively. Ultimately, collapses are not isolated events. They are the result of deep, long-term structural decay. The Great Depression of 1929 emerged from an economy overstretched by speculation, fragile credit structures, and unchecked optimism. Throughout the 1920s, stock prices rose far beyond the value of actual production, creating a massive speculative bubble. Banks lent recklessly, assuming prosperity would continue indefinitely. When confidence faltered, the bubble burst with devastating force. The stock market crash triggered bank runs, frozen credit, factory closures, and unprecedented unemployment. Global trade collapsed as nations turned inward, amplifying the crisis. The disaster revealed the dangers of unregulated finance and demonstrated how quickly prosperity can unravel when built on instability. The human toll of the 1929 crisis extended far beyond financial charts. As banks failed, millions lost their life savings overnight. Families faced hunger, homelessness, and complete uncertainty. Breadlines stretched through cities, symbolizing deep social despair. Formerly prosperous workers found themselves jobless, while small businesses collapsed under mounting debt. Children left school to support their families, and migration surged as people sought new opportunities. The psychological impact was equally devastating. Hopelessness spread as faith in the system crumbled. The crisis exposed how fragile everyday life becomes when institutions fail, reminding the world that economic collapses are ultimately human tragedies. The Great Depression spread rapidly across borders, revealing the vulnerabilities of an interconnected world. As American demand collapsed, global trade contracted sharply. Export-dependent nations experienced severe downturns, while protectionist policies such as the Smoot-Hawley tariff deepened the crisis. Currencies destabilized, governments fell, and social unrest intensified. Many countries adopted austerity measures that only worsened economic pain. The crisis reshaped global politics, contributing to the rise of extremist movements fueled by economic desperation. The Great Depression demonstrated that no nation is isolated in a global economy, and that instability in one region can ignite worldwide turmoil. The 2008 crisis was rooted in reckless lending, excessive leverage, and blind faith in rising real estate prices. Banks issued high-risk mortgages to borrowers who could not repay them, assuming housing values would climb indefinitely. Financial institutions packaged these risky loans into complex securities, spreading danger throughout the global system. Governments, regulators, and investors underestimated the scale of the bubble. When housing prices fell, defaults surged, and the financial system began to unravel. The crisis revealed how technological sophistication in finance does not eliminate risk. When built on unsound assumptions, it amplifies it dramatically. For many households, the pre-2008 housing boom created an illusion of endless prosperity. Easy credit encouraged families to take on mortgages far beyond their means. Banks promoted adjustable-rate loans that seemed affordable, but later became unmanageable. As optimism grew, speculative buying intensified, inflating real estate values to unsustainable levels. When interest rates adjusted and economic conditions weakened, borrowers began to default in waves. Homes lost value rapidly, leaving families trapped with debts larger than their assets. The crisis revealed how consumer confidence, when built on unrealistic expectations, can lead entire societies into financial ruin. The collapse of American mortgage markets triggered a global chain reaction. Banks and investment funds around the world held securities tied to U.S. housing, spreading losses across continents. As confidence evaporated, interbank lending froze, halting financial flows essential to global commerce. Many countries slipped into recession as exports fell, businesses closed, and unemployment climbed. The crisis exposed how deeply interconnected financial institutions had become. A failure in one nation could instantly destabilize economies thousands of miles away. The domino-like collapse emphasized the urgent need for international coordination and stricter financial oversight. The Asian financial crisis began after years of rapid growth, fueled by foreign investment and heavy borrowing. Nations such as Thailand, Indonesia, and South Korea embraced economic expansion without addressing underlying structural weaknesses. Short-term capital flooded in, creating an illusion of stability. When doubts emerged about the sustainability of these economies, investors withdrew funds at unprecedented speed. Currencies collapsed, corporate debts soared, and governments struggled to respond. The crisis revealed the dangers of over-reliance on foreign capital and demonstrated how quickly economic miracles can turn into disasters when fundamentals are ignored. Thailand's financial collapse in 1997 served as the spark that ignited a regional crisis. After years of borrowing in foreign currencies, the Thai baht came under speculative attack. When the government abandoned its fixed exchange rate, the currency plummeted, triggering panic across Asia. Investors feared similar weaknesses in neighboring economies and rapidly pulled out capital. Countries from Malaysia to South Korea experienced market crashes, banking failures, and mass unemployment. The episode highlighted how vulnerabilities in a single nation can rapidly spread through interconnected economies, turning a localized problem into a regional disaster. The Ottoman Empire's decline was shaped by long-term economic challenges. As European industrial powers advanced, the empire struggled to modernize its economy. Weak manufacturing, reliance on agricultural exports, and outdated infrastructure hindered growth. Capitulations granted to European states undermined economic sovereignty, allowing foreign powers to dominate trade. Rising debts, especially after the Crimean War, placed the empire under financial supervision by European creditors. These pressures eroded autonomy and limited the state's ability to reform. The Ottoman economy became increasingly dependent, setting the stage for eventual collapse. Continuous warfare placed enormous strain on the Ottoman treasury. Military campaigns required vast resources, forcing the state to rely heavily on foreign borrowing. As interest payments grew, a significant portion of revenue was diverted to foreign creditors. The empire struggled to modernize its military and administration simultaneously, creating chronic financial imbalance. Social unrest increased as taxes rose and living conditions deteriorated. Foreign powers gained more influence through economic pressure, gradually weakening imperial control. The slow erosion of sovereignty, fueled by debt and war, pushed the empire toward systemic collapse. History shows that civilizations fall not only from external threats, but also from internal economic rot. Speculation, excessive debt, weak institutions, and ignored warning signs consistently lead to collapse. The 1929 Great Depression, the 2008 crisis, and the Asian financial crisis illustrate how similar patterns repeat across eras. Overconfidence, fragile systems, and delayed reactions. Preventing collapse requires transparency, responsible governance, diversified economies, and institutions capable of managing shocks. Civilizations that learn from past failures strengthen their resilience. Those that do not remain vulnerable to the same destructive cycles.